The crypto market has been one of the worst performing assets this year. Over the past 10 months, it's gained less than 3%, a number that's proven quite painful considering the level of risk crypto investors take on. For comparison, gold has risen by 55%, the US stock market is up 12%, and even treasury bonds have delivered 6%. To make things worse, a growing number of investors and media outlets now believe that the crypto bull run has ended, with the market poised for significant more downside from here. And that's actually a fair argument to make today. After all, we've just witnessed a massive leverage flush in the crypto markets. Over 1.4 million positions were liquidated, as we can see through this chart showing the number of total liquidations. This wiped out over $19 billion worth of leveraged trades, making it the biggest 24-hour liquidation ever recorded. And it forced over 1.6 million leverage traders out of the market. As a result, crypto sentiment has fallen to levels that are associated with extreme fear. This is some of the lowest levels we've seen since this bull market began in late 2022. But the scale of this liquidation did more than just shake out retail speculation. We can see that through this chart showing Bitcoin's average leverage order size. Each bubble represents clusters of leveraged positions, with green and yellow representing orders by large players, and red showing smaller retail trades. Every sustained rally since 2024 consistently saw large green and yellow bubbles, indicating strong participation from high net worth traders. But following the recent liquidation, those large clusters have completely disappeared. In other words, this flush cleared out not only retail traders, but also a large portion of the bigger players who have been driving much of the leverage earlier this year. What remains now are mostly small red dots, so retail-sized orders. As a result, the average leverage order has dropped from $10,000 earlier this year to just $2,000 today. That's an 80% collapse, showing how dramatically speculative capital has pulled back from the market. And that's not necessarily a good thing. Without larger players making directional bets, the market can often struggle to generate momentum if there's not enough underlying demand. This is what happened back in early 2025, for instance. We primarily saw participation from retail traders who were unable to push the market higher.